Hello, everybody. Not quite Friday, but tomorrow I will be on the road and not able to post a video, so I figured I'd do it today. Um, going to continue the conversation about business entities. This week, I wanted to discuss partnerships and some of the benefits and downsides to partnerships. So, partnerships are basically, for tax law, two or more sole proprietors working together to run a business. And they are taxed just like that. For example, a sole proprietor owes a self-employment tax on their entire profit. The same thing happens with a partnership. So if you have two partners in a partnership that makes a $200,000 net profit or taxable profit, they will each get issued $100,000 through their K1 as their taxable profit, regardless of the cash flow. And then they will each have to report $100,000 taxable profit on their personal 1040 and be subject to self-employment tax at 15% on that same $100,000. So that's the general idea. There are some different things at play with partnerships. For example, you could bring in a limited partner and they're not subject to self-employment tax. So a limited partner is basically a quiet investor. They give you money, they get share of profit, but they're not subject to Social Security tax because they have no actual active involvement in the management of the company or its operations. So that would be a limited partner. Whereas a general partner or a managing partner has more liability in the company and their profit is subject to self-employment tax. Same as with sole proprietors, partners in a partnership cannot receive normal wages. Instead, they get what's called as a guaranteed payment. So a guaranteed payment would, for example, would be basically in a partnership. Let's say you have four partners in this partnership running it. Three of them are silent partners where they've invested money. And then the fourth partner is the general partner who is operating the partnership. As a way to compensate him for his time in running the partnership, he would receive his guaranteed payment, which is similar to wages for management of the company. And then that would be deducted as an expense on the partnership before profit or loss is calculated to all four partners equally based on their ownership percentage. The nice thing about a partnership is versus a corporation is that a partnership, because it is separate sole proprietors working together, that is how equity is treated as well. So if you have four partners, you have four equity buckets. Basically, everybody has their own equity bucket. So if I contribute to the partnership, that increases my personal equity in the partnership. And if I take out a distribution from the partnership, meaning I take out cash, then my personal equity bucket goes down without affecting the other partner's equity. That may or may not be cash available for something like that, but that is how it is addressed. So if there is, let's say, $50,000 available to distribute from a partnership, and one of the partner has more need for that than the other partners, let's say they have some medical bills or something going on, and as a partner group, we sit down and we discuss it and we say, hey, you know what? I am willing to take less of a distribution this year so that you can go pay for the medical expenses that you have. We can do that. And my equity will not be affected by the other partner taking out more cash. Their equity will go down more and my equity will stay the same. That's the nice thing about the partnership versus a corporation, whether it's an S corporation or a regular corporation. There is one equity bucket unless we're talking about other types of stock. But in general, you have one type of stock, common stock. And so there is one equity bucket. And so what happens is if there's a distribution, it goes out equally on paper based on ownership percentage. So if you own 10% of the corporation and there's a $100,000 distribution, you get $10,000 distribution on paper, whether or not that's how the actual cash flows. For example, that same example, let's say one of the partners has some medical bills. We sit down as a partnership group and we say, you know what? partner B over here needs this money to cover their medical bills. We understand, we all agree to it. And so we allow that partner to take more of a distribution because we have the cash available. Well, if we're equal partners and let's say 50-50 partners with partner A and partner B, and partner B takes out a $10,000 distribution to cover their medical expenses, on paper, partner A and partner B both took out a $5,000 distribution. That may or may not come into cause any issues, depending on the relationship with the partners. It really can come into play if you are trying to bring in another partner, or you're selling stock in the company, or you're trying to sell the company in general. Your long-term capital gains and short-term capital gains and all that tax calculation stuff will be affected by your equity in the company. And so if you receive no cash, but your equity went down, that means you're going to pay more capital gains tax on the sale of your company when you didn't get the cash that resulted in that capital gains. So that's one of the benefits with a partnership over a corporation, is that you can distribute cash out unequally between partners. Partnerships also have a lot of flexibility in how anything is distributed. So typically, if you own 10% in a corporation, you are going to get 10% of the profit, the loss, the equity distributions, or anything that's affecting the corporation. You will get 10% of it. In a partnership, you can sign an operating agreement or a partnership agreement with your other partners, and then that agreement is law for the partnership, unless it is so grossly opposite of normal business law that the courts won't allow it. But for the most part, when you sign a contract for a partnership agreement, even if it goes completely against the norms, in the most part, that will be the ruling factor in how things are distributed or things go on in this partnership. For example, you could have a partnership where you have an agreement where if we turn a profit, the partners will get distributed the profit equally. But if there is a loss, the one partner will get the loss completely in order to lower the managing partner's taxes. Or you could have distributions unequal. You could say, well, we have $100,000 for distributions. Partner A, who is the managing partner, has put more time into this, so let's give them 75% of the distributions, and 25% goes to partner B, even though we are 50% owners in the company. So there's a lot of flexibility in a partnership and how everything is distributed out versus a corporation that it's all set in stone based on ownership percentage. Partnerships can be very, very flexible that way. You can structure very unique deals based on the industry you're in, which I see this in some different types of industries, such as like oil and gas exploration and different things, like basically things that there is a high risk but high reward. In order to minimize the risk to some of the higher paying investors, they may structure a deal through a partnership that benefits them more in the event of a loss, and then more equally in the event of striking oil. So there's a lot of things that can come into play in a partnership. But the problem with the partnerships is that, or if you are an operating or managing partner and you're actively involved, your entire profit, whether it comes in the form of guaranteed payments or profit distribution, paper profit distribution based on taxes, not necessarily cash flow distributions, will result being subject to Medicare and Social Security tax called self-employment tax. So that's the biggest downside to a partnership. The biggest upside to the partnership, the biggest benefit, is the flexibility in how things are distributed, regardless of what a thing could be. Profits, losses, tax credits, depreciation, anything involved with a partnership can have different depreciation allocations based on your partnership agreement. That's the benefit to the partnership over the corporation. The downside is on the tax side is that self-employment tax. If you are a actively involved partner, you're going to be subject to Medicare and Social Security tax in the form of self-employment tax. If you are a limited partner, that means this is a passive activity. And I've talked about passive activities in a lot of previous videos, especially involved with rental investments. If you are a passive partner, you will not ever be subject to that Medicare and Social Security tax or self-employment tax. There are some other types of taxes you might have to deal with and called net income investment tax, NIIT. I'll make a movie about that someday, but that's not the point of this. But there are other taxes that could be involved. But for the most part, in general, you're not going to be subject to self-employment tax based on your share of the partnership. But the problem is because you're passive, if you generate a loss, you cannot deduct that loss. It will be limited until you either liquidate the partnership and it releases those losses, or you have other passive gains such as rental properties or other investments that generate a profit to deduct against those passive losses. So those are the two biggest downsides to a partnership, is either you're subject to self-employment tax as an active partner, or you're subject to the passive loss rules as a limited partner. Well, the passive loss rules, there's not a lot we can do. There are some different things we can structure around that to kind of help that. And mainly it is, well, if you have other passive income, get rental properties, how can we structure some of the things to use up those passive losses? Or, do you buy and sell passive partnerships? There's not a lot we can do with that. You're just kind of stuck with your passive loss until you liquidate. But on the active side, the typical structure is we set up the partnership at the top, and then instead of being owned by individuals, we set up the LLC partnership at the top, and then each individual partner owns a separate LLC that is the partner in the partnership. And then that LLC is taxed as an S corporation. And so the profit being distributed out of the partnership at the top passes through the second LLC, S corporation, and is the revenue for that LLC, the taxable profit revenue that passes into that LLC. Then that LLC says, great, I made $100,000 in profit. Now I'm going to take some additional expenses against that. And then I'm going to cut a W-2 to minimize my Medicare and Social Security tax to the partner in the partnership. So that is a great way to have a step down from an operating company to the partners involved in the company that are managing it in order to minimize and control that Medicare and Social Security tax. It's a great way to take advantage of some employee benefit packages that you may or may not want to offer to all the employees in the company. For example, a 100% medical reimbursement plan. And it's also a way for you to take some other expenses available to you personally as business expenses that may not necessarily be available to the partnership in general, such as like a home office deduction. The partnership has a brick and mortar it's operating out of, but your personal LLC that has other activities going on, you manage from your home office. So that's a way that we can take additional expenses. So you have not only a step down where you can minimize your Medicare and Social Security tax, but now you can also have a bigger step down by adding other expenses into that. And so that's typically what we find when you have multiple unrelated people working together to operate a business, is you have a partnership at the top level, at the highest level, being the face to the public and providing the services, but each of the partners are ran through separate LLCs, taxes, S corporations, where we can get more aggressive on some of our business expenses without necessarily having to provide those same benefits to all the traditional employees. Anyway, so that's kind of a quick take on what is a partnership, its benefits and its downsides, why we would use one. I love partnerships. I don't have very many clients in partnerships, mainly because most of my clients operate as their only owner. But those that have multiple people involved, we run them through partnerships in order to allocate out distributions, profit and losses however we want to, through individual equity buckets, passes through an S corporation to minimize self-employment tax, take additional expenses on it, and that's how we set things up. Now, the more LLCs you have involved, the more administrative costs. You got to keep that in mind. That's another downside, is that now if you have two partners working together in a partnership passing through LLCs taxes S corporations, well, that's technically three businesses. So now you have three separate LLC annual reports that have to be filed. You have three separate bank accounts, three separate credit cards, three separate sets of QuickBooks, and three separate tax returns that have to be filed. So you have tripled your administrative costs. So there is a break even to making the decision to move forward with this. But it is definitely by far the best way to do things in order to keep partners operating together in a happy environment where they're not mad at each other for whatever reason. And you're able still take advantage of some of those amazing tax saving strategies available for S corporations. Okay, until next week, have a great weekend and a wonderful week. And hopefully this video is beneficial for some people as you think about possibly creating a partnership with some other people.